So that's the word that we got from NS Venkatesh. Now let's connect with our experts and figure out what they make of the kind of data that we've got, and perhaps help us with our portfolios as well in terms of what we are doing right, and perhaps in this kind of interest rate scenario, the rising interest rate scenario that we're living in, whether we are getting our strategies right. Amit Kukreja is joining us. He's the founder of AmitKukreja.com, along with Anant, Ladha. He's the founder of Invest Aaj for Kal. Great to have you with us. And I'm looking at the kind of, the data that is pointing towards SIPs right now and the kind of growth that we are looking at. Amit Kukreja, would you believe that this is the kind of growth that is going to sustain? Why exactly do you think it is happening right now that we have this sustained interest in investments through the SIP route? Is it going to be a temporary phenomenon, or do you think it's going to sustain?
No, this is definitely going to sustain, Vikram. We have 2 or 3 very broad principles and the reasons why this is happening. One, we are a number 5 GDP economy worldwide. We have just overtaken Britain or UK, right? And we are a younger population, a very young workforce availability in the country. Thirdly, we are a developed country, if not a developing nation anymore. When all these factors put together a positive image about the country, obviously that leads to a lot of attractive investments done by the other countries in India, younger population to work with, which means we have a much longer horizon with this workforce to leverage them in enhancing our GDP capacity. And thirdly, the awareness has gone up. People are now aware. They have understood what the market cycles are, what the crashes are, what the bull markets are, and what is the advantage of continuous SIP in the falling markets and the rising markets. They understand cost averaging. Equity mutual fund is still about 5 to 7% of the investments countrywide. But I think, not even 5 to 7%. Overall mutual funds is 5 to 7%. But people are now aware. So we have broadly these 4 or 5 things which are continuously driving the SIP calendars. And I anticipate these numbers to continuously grow month by month basis.
Fair enough. Do come in on this, Anant, Ladha. I'm looking at the sectoral or thematic funds, and they're seeing a net outflow as also from the focused funds from the data that AMFI has put out. I'm sure there are funds right now that you would strongly suggest that investors stay away from. What would those be?
See, basically, major places where we are seeing outflows in thematic fund are the IT funds. Everyone was almost running after IT funds, be it India or be it international market. But in last 1 year, we saw that there was a lot of choppiness in the IT sector. And finally, we are seeing some outflows. If we talk about some of the don'ts in mutual funds, first can be, if you are a new investor, stay away from sector funds. You can probably choose a flexi cap or a multi-cap fund. Or if you want to start from basics, you can even choose an index fund and start your investment journey and avoid sector funds to start off. Second, you should avoid lock-in funds, especially at the start of your journey. Only exception to this point is that you can invest in LSS, which comes with 3 years of lock-in fund. Other than that, you can avoid other lock-in fund for the time being, and so that you have complete freedom of choosing your funds. And if required, you can even change your funds according to your own mindset without any restriction whatsoever. And final important point to take care of is not to run after small caps at the starting of your journey. I am personally a big fan of small cap mutual funds, but if you are starting your investment journey and if you are a beginner in mutual funds, it is better to start with something which is more stable, maybe index funds or maybe flexi cap funds, and slowly and gradually you can move towards more volatile but more fruitful stuff as well.
So, Amit Kukreja, apart from what Anant Ladha is pointing out, many investors are wondering that with these high interest rates, going ahead, the possible benefits of a drop in interest rates as well, if one has to capitalize on these changes within our economic structure, whether it is a good idea to invest in long-term bond funds like the gilt funds. Should they go with those, or there are better options out there for the period of time that we are currently in?
See, the risk that these long-term bond funds carry because of the interest rate changes is as good as a risk that you take by investing in large cap equity mutual funds sometimes. So if you are open to taking risk and you are not risk averse, then I would rather suggest invest your money, which is a fixed income allocation, into a simple large cap index fund. As simple as that. But if you want to capitalize the fixed income cycle, then don't go beyond short term funds. So, short term funds are decent funds. They have a decent YTM, or most of them have 7+% YTMs with predominantly AAA rated papers in it. Anything beyond short term, for example, medium can also come in because they also have decent YTM. So, beyond medium term, I would not suggest buy debt funds for long term or credit risk or duration, etc. I would rather have the investor invest in equity mutual funds to take care of that kind of volatility in towards his or her advantage.
And Anant, when it comes to sectoral funds, there must be shifts that are happening, and some of that is coming through in the data as well. Where do you see the traction now, and where do you see it go? Which are the themes and sectors that you see drawing more investor interest, or what should draw more investor interest according to you?
Of lately, what we are seeing in sectoral funds is people are majorly redeeming their funds, and money, if any, is going in any of the sector funds. It is the banking sector which is attracting money, because of lately we have seen that banking sector as a whole has outperformed, and in growing economies, usually we see that sectors such as banking, such as infra, or maybe defense usually outperform. So these are the sectors, particularly banking is the sector where we are seeing some inflows. And being a retail investor, if you actually want to have a sectoral fund exposure in your portfolio, make sure that you have limited exposure and you are choosing a sector which is actually underperforming in recent past. Whenever you invest in sector funds, you don't run after the best performing fund or the best performing sector in last 1 year. Rather, you try and find out the cyclical nature in the sectors, and you try and find out which is probably one of the sectors which is underperforming, so that we may have some value opportunity out there.
Value opportunities, according to you, Amit Kukreja, because I'm looking at the PSU Bank ETFs, the international funds. They have been the best performing equity schemes. Do you believe that they will keep growing, or are the opportunities elsewhere now?
So if you look at the international funds outside India, there's a good correction happening. So I think this is a good time to invest in the international funds like NASDAQ or Vanguard Value ETF through the US Stock Exchange. Even China is going through a big corrective cycle because of their COVID policies and the changes that they're trying to do. So when the markets are crashing, when the sentiment is of fear, I think that's the sentiment of the investor, of a right investor, to enter with the mindset of greed, right? So we have a lot of good corrective cycles happening outside India. So it's a wonderful opportunity for an investor to invest money outside India.
But a lot of people will talk about the Indian growth story, and like Anant was also talking about, there are certain sectors, but sectoral funds haven't been doing that great. But certainly, we know the sectors that one should stay away from, Anant. You did mention IT, but do tell us where you see the pockets of growth right now, which are commensurate with the kind of gains we are seeing within that pocket, even on an economic scale. If you look at it from the macro picture in India, where the growth possibilities lie more extensively.
Anything which is related to old economy sectors. See, if we check out the cycle of sectors in last 20-25 years, we'll see that from 2004 to 2008, there were pertinently sectors such as defense, old economy sectors, which were performing well. Post that, we saw amazing run in consumption story and IT story. And now again, we are seeing a cycle where old economy stocks are doing well because firstly, we will even have to look at the budget. What do we have in budget, and where is the focus of government in coming years? That will be an important role to decide which sectors can perform well. But looking at past budget and past expectations out there, I think anything which is related to development of India, be it infra, be it cement, be it anything related to old economy, be it banking, these are the sectors where we can have some good opportunities. If we are looking for some short-term opportunities or short-term technical opportunities, not immediately, but eventually IT and pharma can also pose some opportunity. But I think we still have some pain or some time out there.
Kukreja, do you find that we are very focused on equity funds, that a majority of our investment attitude is geared towards equities, and there are many more opportunities beyond equities? Do you see that changing? And if so, how should one strategize for them at this current juncture that we're in?
So Not much of a change required, Vikram. If you are a beginner in investing, so the best place for you to start investing in mutual funds is a combination of debt funds and index funds. If you are a seasoned investor and you have an investing experience of more than 8 years or 10 years, then you know that the bear cycle and the bull cycles, they keep happening. And the only way you can make a good alpha in your portfolio is keeping a good exposure to multi-cap funds or flexi-cap funds. I'm not a big fan of sectoral and thematic funds, but that doesn't mean I'm wrong or right. It's just your preference as an investor. If you really want to sleep over your investments and check out your portfolio 5 years, 10 years later, then the best way to get into your mutual funds is direct plans, flexi cap and multi caps, where you would see a decent double-digit returns. So nothing changes significantly based on the external changes at the moment. These are all fundamentals and investing principles that have stood the test of times, and we should continue investing on a regular basis. One thing that I want to call out is that if you're seeing a bull run in your India portfolio and your financial goal is just a year and a half or 2 years away from today, my suggestion would be to redeem your equity portfolio and move that money into fixed income, because you don't know when the markets are going to come down, and you don't know when the good return that you're seeing when you end up losing that. So if your goals are near, within 2 years, it's time to start booking profits in equity funds, stagger your withdrawal strategy, redemption strategy, and ensure the whole purpose of using equity mutual fund was to fund your financial goal. That purpose shouldn't get defeated. So while your strategies remain the same, while your timing of holding your investment remains the same, the timing of exit also plays a very important role. Otherwise, you'll be sabotaging your financial goals for which you started these investments several years ago or few years ago.
The goal-oriented nature of our SIPs, now that needs to be revered and need to be focused on. As far as the markets are concerned, yes, they will go up and they will also go down. The idea is to keep investing systematically, which is what SIPs allow us to do. And we'll always have guests like Amit Kukreja and Anant Ladha telling us exactly how to strategize and make the most of our portfolios, for which we are ever so grateful. Thank you both for joining us on this edition of India Tonight.
Thank you, Vikram.